Steve Sosnick is back. He's chief strategist at Interactive Brokers. Good to see you.
Great to see you, Kelly.
So before even diving into that excellent point, I just want to pick up on what we were saying with Steve there. I mean, not to get, too podcasty about it, but the idea that over time, you've got to own real estate then. You've got to own stocks. You've got to own the things, David Zervos talks about this, right? Like the whole system is set up to favor those who are holding the quote unquote real assets, and purchasing power over time, as we know, is just going to keep getting eroded. So it's quiet, it's subtle, but it's there 2 or 3% a year. And it is an environment in which stocks can still do well.
Well, we basically have a debt-based economy, and that debt is being used to purchase real assets to a certain extent, right? Ultimately, that's how companies work. That's how real estate works. That's pretty much how most things work. And so we're biased in that way. That's why we're so freaked out if the Fed doesn't cut rates, because so much depends on that. But yeah, so in the short term, or even in the longer term, you do want to have some real assets. That's why gold had the run it had. It has pulled back a little bit recently. But in many ways, I like to think of gold not so much as a crisis hedge. It is if you live in a country that can't pay its debts in its own currency, but it's more of the anti-dollar if you live in the U.S. It's just something that's denominated, that has a value, an international value, and being denominated in dollars. If the dollar weakens, gold does better, and that's probably the best scorecard, as opposed to real estate, which is tougher to measure.
Sure. I mean, it's more the point that you have to own stuff, because it's going to get harder and harder to buy this stuff over time, because the prices are just going to keep going up and up. So you want to kind of earn in real dollars. You want to own stuff that's going to hold its purchasing power. So I don't know how this all translates to momentum and the tactical in the market, but it kind of would explain when people go, well, wait a minute, why is the stock market at all-time highs, but bond yields are still fairly high, the dollar is still kind of weaker this year? Is it sustainable for stocks to be high? Well, yeah, it's sustainable, but it might not necessarily be painting this beautiful picture of a strong real growth economy in the very, very long run.
Stocks can do well, though, in a modest inflation environment, because you're buying a share of real productive assets. And so, as a result, that is why they can be a good inflation hedge. If you start to get into double digits, well, that's a whole other different story. And I don't think we're anywhere near that. But if you are talking about modest inflation, that's where stocks can do quite well, because the companies that you're buying the stakes in have real assets and real businesses, and they're productive, and that's one of the ways you can hedge against inflation. That's why it does work.
In a way, this happened during COVID, and this time is a little bit different. I find this Walmart fight very interesting with all of that, because during COVID, companies weren't trying to hold the line. They were shoveling price increases because consumers had the income from the government to help spend on that, but also because they were able to increase profit margins under the guise of everything's going up, and they do benefit from that. This time, we're seeing much more advertising geared towards hey, we're not going to do this. It's some of the car companies, the wireless carriers, Verizon and the rest. Now here's Walmart saying, we're trying to hold the line. The president's encouraging that, of course, but it's in the company's own interest if they don't think the consumer can handle it. And look at Sentiment Friday. So that feels a little bit different and points towards more pressure, I guess, on corporate profit margins.
Absolutely does pressure margins, because they can't pass things along. Now, the companies that aren't really as affected by tariffs, their margins do benefit. I think of sort of the washing machine issue, during the Trump one, when, the foreign washing machine prices were raised to sort of be helpful to Whirlpool and the like, and Whirlpool was able to raise its prices, basically because LG and Samsung had to as well.
Yeah.
So there's a lot of moving parts in all this stuff. But yes, if there's price pressures coming in from abroad, that has no choice but in the broad sense to have an impact on profit margins.